Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending August 21st, 2020. I'm Preston Brenton. Thanks for tuning in. Remember guys, don't be the rat brain trader. We all want to be the red striped zebra. And this week's theme, I guess, is someone finally going to take a bite out of Apple? Well, we're going to see that, I guess, shortly outside of the 4-to-1 stock split. But let's just take a look at where we've been this past week and how things are going to kind of shape up here. So if we look at it, when we take a look at the performance, you can see here that the Dow, S&P, and NASDAQ all finished in the green for the week. The Russell was the only one that finished in the red. They came in at 1.61%. Year to date, the Russell is obviously in the red with the Dow, but we do have the S&P and NASDAQ well and constant in the green year to date. Okay, the S&P is up 5.15 and the NASDAQ's up 26.07. Now, if we look at the valuations, you can see that the PE ratio, the trailing is 35.35, the forward PE ratio is 26.17, and while elevated, it's lower by about 26% from the trailing. The reason why it's still elevated over about a decade average of about 15 or 16 is because of the very low interest rates. You can see the dividend yield is 1.79%. 10-year treasury at 64 basis points. So the spread between the dividend yield and the 10-year treasury is standing at 1.15%. Still pretty wide, so that forces a lot of money still in the equity markets. You can see the current VIX actually finished slightly higher this week from last week's close. It's up about 2.22%. It closed at 22.54 for the week. And if we look at the sector performance, you can see that technology was the best, coming in for the week 3.64% in the green, and the worst was energy, down a whopping 6.19%. You can also see year to date technology is performing the best sector for the year, as we would expect, coming in at 24.54%, energy down 43.01%. And of course, if we look at the world index there on the bottom of the screen, you can see there's only one index that was in the green for this week, and year to date it's in the green. That's China. All other indexes performed in the red this week, and year to date are in the red, with the FTSE over in London still in an official bear market, primarily because of Brexit, because they really can't figure out what they're going to do, and the negotiations seem to be falling down with every offer and counter offer with the European Union on just how they're going to handle trade and cross-border transactions. So that's putting a lot of pressure on the FTSE. But even then, the CAC 40, the French index, is down just slightly under bear market territory at 18.10%. And the Hang Seng, the Chinese, or the Hong Kong index, is down 10.9% with the problems going on over there. So that's what we've got for the week. Now, if we take a look at the weekly sound bites for the week, the markets, as I've said, have continued to rally. This is the fourth straight week for the S&P. You know, technology kind of led the way, powered mostly by Apple and Tesla. And it was kind of a milestone, really, that marks a round trip rally from the lows to the highs that we saw. The lows March 23rd to the highs of where we were this past week, over a 52% gain. Folks, that's the fastest bear market plunge and the second fastest bear market recovery in U.S. market history. Economic data and corporate profits released this past week showed that the recovery is still progressing, yet it's kind of uneven. Okay. I mean, after a 1 week reprieve, we did see the weekly jobless claims rise back up over 1 million, and a measure of manufacturing activity for both the New York and Philadelphia regions came in below expectations. And the Feds this past week, in their meeting minutes, they highlighted that risks still remain in the markets. As such, they are strongly encouraging the U.S. Markets are going to need more fiscal stimulus, but the bickering continues with the Dems and the Republicans on that, so we haven't seen any movement in Congress yet. And one of the bright spots this past week was existing home sales, up the most on record in July. Boosted, of course, you know, the mortgage rates are very, very all-time lows, low inventory of houses as well. And we did see a few big box retailers, you know, reporting Q2 results, saw in their profits just surge during the pandemic. And there were clear pockets of strength, of course, with the economy, but unemployment still remains dramatically elevated, highlighting the need for this fiscal package. So it's going to be kind of a coin toss on just what the politicians are going to do, because this is silly season, folks. We got the national presidential elections coming up here in November, so it's really going to be just batshit crazy, I believe. And inflation, it's still going up, but it's still subdued, though, really. Over the next 12 months, analysts expect earnings in the S&P to drop by about 14.5% to about $153 per share on the S&P. Okay. Additionally, bond markets look just a little bit different too. Rates that are already low in February have declined even further. As I said, the 10-year rates, they've closed out the week at 64 basis points, so very low. The federal funds rate, as I said, near zero. Treasury and corporate bonds are supporting the economy because the Feds just keep a lot of liquidity in the markets. We're also seeing economic indicators like an inflation and consumer confidence. They've continued to soften, as restrictions on economic activity with a lot of companies still closed here to try and contain the coronavirus infection rate. So it's also suppressing consumer demand. Meanwhile, on the supply side, guys, we're seeing industrial production, which includes basically manufacturing, utilities, and mining. It's continuing to improve a little bit, but it's well below the pre-pandemic levels. So factories are continuing to recover as well. So there's a little bit of an uneven recovery in the markets, but clearly technology is just kicking butt right now. Also, analysts believe that there's a corporate according to one analyst in Barron's this weekend, or several actually, they think there's only one thing standing between a really full bore recovery and a double dip recession, and that might be the back to school season and the degree which schools open. Okay, as we move into September, remember schools are supposed to be opening, and there's like over 56 million K through 12 students just getting ready to start this new school year, and it's going to be crazier like no other school year I can remember. And the big issue is how many are going to be attending school from home via online, the sessions like Zoom and others, and how many are going to be in person. And is clearly going to set the tone for the U.S. economy and sentiment as we move into the fall, November, early November elections, presidential elections. As the share of parents they can't go back to school, with school closures. As that share goes up, or if it goes up a lot, it's going to lose a lot of productivity and hit the US GDP. A lot of analysts believe it's going to hit the US GDP over 2 or 3% of US GDP, which is amazing. The other thing that a lot of people don't think about back to school is child care issues are rising, social retardation with kids not going back to school, absence of consistent school learning. So the cost of keeping schools closed not only is this high social factors, but there's a huge economic impact as well. So there's just a lot of ifs, ands, or buts in this economy, yet the markets continue to blast higher. Now, as I've been telling our members, it's not all about where we are with the economy. It's where the market and price action is, because I've said over and over, price action and the markets are not the economy, and vice versa. So let me just switch the screen over here. Let me just get this up for you guys right here. Um, and I'm going to just kind of get this over here for you. Take a couple of seconds to paint the screen there for you. But what you're going to see is a daily chart of the SPX, the cash index. And as you can see on the cash index right here, we've hit all-time highs. This is a daily chart, and we hit all-time highs on Friday at 33.99.96. You can't get much closer than 3,400 than that. And you can see the MACD has got a little bit of a divergence from the highs that were hit back in early June. All right, but this is kind of higher than the previous high here. So this tells me that any pullback is going to be bought. And you can see now this is simple moving average. It's not exponential. You can see the cross here in early July. You can see here where we've got the 50 EMA separating from the 200 EMA, the yellow line, And I've got these elements here that represent potential pullback points. You can see the Fibonacci retracement tool on here. Roughly a 23% pullback takes us down to around the 3,100 levels. And I've seen a lot of analyst charts indicating 3,100 is a good pullback point. Now, I've been telling our members that the markets, I've had our guys getting and gals getting it long the market since really early April. And then we've used every opportunity, every dip to buy, just because of what I saw as a setup as a great opportunity. I think we're going to get another dip in the markets. Now, I've been saying this since July. Really, I thought probably the end of July going into August we'd get the dip. Now we're almost coming 3/4 of the way through August. And just in a couple of weeks, we got a long Labor Day holiday weekend here in the United States. Markets will be closed on Monday. And school kicks off. And by then, the charts are indicating another dip, another pullback, much like we had back here in June, early June. And I don't see a very strong dip, because when you make new all-time highs from previous all-time highs, then the markets do dip, but we're not looking at anything serious here. Okay, I mean, that's just kind of what I'm seeing right now. Now, if I switch it over and we put the E-minis on here, and let's just put the futures, you will notice in the futures, we have not made new all-time highs, right? You can see just how close we got. I mean, we just cannot seem to broach this 33.9750 in the futures. And we did take out the prior all-time highs back here in June. Took us a while to take it out. As you guys know, I've had my target here at 33.10. I put that up there right after we pull back in early June. That was my new target. And we hit that new target in early of this month, August the 5th, about 15, 16 days ago. So you can see here that we're stalling out at this level here, and you can see I've got a couple of potential pullback points that would take us back into the red year to date. Anything below 32.36, we move into the red. Now, as I've told our members, 3,200 is a key level for us. I want that to hold. You can see that second pullback is estimated to be around 32.01. Okay. So if we can hold that, notice the MACD is running flat, which means it's more of a consolidation phase. Remember, there's a number of different ways the markets can consolidate. One way is pulling back and then just sitting and resting for a bit. Another way is just running sideways in a chop. All right. So there's a number of different forms of consolidation. One is time and one is price. Sometimes both of them play a role, one bigger role than the other. But this is what I'm looking at right now in the markets, guys. We need to be very careful with this market. Even if we take out the all-time highs and just move up over 3,400, I'm still expecting a 3 to a 5% pullback, down to around the 3,300 level. If we go below that, next stop 3,200, would not surprise me at all. Okay, and the way we played out on Friday, you can see we made several attempts to get over this. And if I just put it on the 5-minute chart here, you can see the several attempts that we made at making a run at the all-time highs. We made one attempt around 3 p.m. We had the dip. We made another attempt going into the end of the day, and we just could not get up there. I mean, we literally were just a 1.5 away from all-time highs. Generally, when you get that close to all-time highs, the markets just go up there like a bug to a bug zapper. It just takes it off, takes it out, and then you'll get a pullback. Could not manage the energy to do that. And then, as you can see in the close, the last 5-minute bar, we gave it up. And then in the close, right after close, it just kind of came right back down to the level that we had before. So now if I put it back on the daily chart, and I take us back to the beginning of April, which is when all the buying volume really came into the markets here. You can see this volume over price, this purple here. And you can see there's a big level right where we are here. So the buyers and sellers are almost in equilibrium. You can see right below the 32.36 opening price for the year, the dividing line between being in the red and being in the green for the year. There's a lot of buyers sitting right in this area here. The buyers eventually won out. So we got a lot of potential supply here. where if we do pull back, I would expect support around that 3,200 level. Now we're at 33.91, so pulling back to 3,200, it's 191, call it just about 200-point pullback. Okay, so that's a nice little pullback that personally I would like to see happen, and then that would give impetus to the bulls to jump back in again. Okay, so that's a little bit about what I'm watching here on the markets. And of course, if we come over to NASDAQ futures, let me just see if I can find that. It may not be in on this one right here. No, it's not on this one. So if we come over here, I'm going to switch you over to NASDAQ. First thing I want to look at is the FANG index. Okay, so if we switch the screens here, and I'm just going to bounce this over to this right here. And you're going to see on this screen right here when it comes up, I've got a special index that I made of a number of different stocks. In this index, you can see I have Microsoft, Apple, Facebook, Amazon, Google, Netflix. This is kind of a user-defined watch list, or an index rather. And you can see we took out the prior all-time highs that were made back in July. We took that out on Thursday and then into Friday. So we've made new all-time highs. You can see here on the MACD from this high right here. It doesn't look like there's going to be any divergence, so that means any dip is probably going to be bought. So we're still being led the way by these stocks. Now keep in mind that August 31st, Tesla is going to break 5-1 stock split, and then Apple is going to break 4-1. Now, Apple is a big component of the Dow, but because of the way Dow does their market weighting, Apple is going to lose a lot of the bite that it has had in the past with the Dow weighting of that particular stock. It's not going to affect the S&P, but it will affect the Dow. So this is a little bit about what we're seeing on the screen here, right? And then if we come in here and we look at the volatility, right? Let me just put VIX on here. Here we go, right here. You can see that we actually managed to move back into the red a little bit. You can see these zones. I use these zones as just general guidelines for different option strategies for our members. And just to think about different ways to play the same option market. Remember, you can be bullish and change your strategy from long or short volatility. And you can be bearish with either long or short volatility. And when volatility has been this high, and then it's working its way down, we can expect these periods of volatility spikes like we've seen here, just looking on the left-hand side of the chart. So I would expect a little bit of a bigger volatility spike over the next 3 or 4 weeks as we go into these September months. Keep in mind with the election coming up, we're probably going to get more vol spikes as the markets start to find and pick winners and losers in this market. But they've gotten it wrong in the past. They clearly got it wrong in 2016 as they did over in Britain. With the yes/no vote and the Brexit, they got that all wrong. So I think the polling samples here are also going to probably be ignored, and the markets are going to just play right up into the election. The way they're doing the election this year, I think there's going to be issues. So I don't know if we're going to know on the next day like we did with the Clinton Trump campaign, but we're going to be up late at night trading it because I think there's going to be some opportunities. Okay, so this is volatility. Be very careful with this vol market. And if we come over here and we look at bonds here have been in this range for quite some time. And if I told our members, we got option strategies that play this range, and that's what we've been doing. All right. Now, I think eventually bonds are going to break. If they're going to break this 170 and they're going to start going down. But right now, the Feds are committed to keeping interest rates fairly low. So that's what we can expect, which means bonds are not going to get too far outside of this range, 182 to 177. So we want to take advantage of it while it's here. Okay. And then, of course, if we look at the 10-year interest rate, which is the gauge for market risk worldwide, you can see it's the same thing. It's playing right inside this range here. And that's what we want. I mean, it's just going to stay here for a while. But I do believe interest rates are eventually going to start to move higher like we had right here in June, early June. We're going to see them moving, just not yet. Currency-wise, the dollar is moving up off the lows, trying to get back up. But notice here there's no divergence in the MACD, which tells me that any rally is probably going to be sold. There's just so many people shorting the dollar now. Now, I do believe it's kind of a crowded trade as this thing has just rolled over, more and more shorts piled in. And it's going to make counter trend rallies even faster to the upside. Okay. So we can expect more counter trend rallies in the dollar. But for those of you that want to trade it, there are a number of different ways to trade the dollar. For our members, I go through, there's 3 or 4 different ways to play the dollar that are really good if you can't get into the dollar index. And remember, it is a dollar index. So when I say trade the dollar, you're really not trading the dollar. You're trading the dollar against a basket of other currencies. The euro is about 57.6% value of the dollar. The yen is 13.6 and the pound is 11.9. So when you add all 3 of those up, what do you get? About 80 or 90% roughly, give or take a little bit, of the value of those 3 currencies against the dollar. So where they go, the dollar is going to go in the opposite direction. So if we look at the euro, and the euro is the easiest one, right? If you look at the euro, you can see this chart looks exactly opposite of the dollar. There is no divergence here, so any dip back down here, I'm going to be more of a happy buyer than I would be a seller. All right, and you can play the futures on this. You can play the options on the futures, or you can go the euro dollar or the dollar euro, however you want to play it in the Forex. I like the futures market a little bit better in trading this, although the Forex is probably a purer play, but the futures and options on futures on just the euro is also a cool way to play it. Okay, so these are the ones that I like. If we look at the British pound, they've had trouble because of Brexit. You can see it's been trying to follow the euro, but I think it's going to reach its apex here. It's not going to go much higher. Now, once the Brexit deal is done, or we get word, the market feels that the Brexit deal is going to be done, we're taking off to the upside. You can see that clear resistance level here. If I put it on the weekly right here and just step it out, you can see these resistance levels here. If we take this out, it's going to be a mad dash, okay? And the euro should be a little bit higher. It's going to be a mad dash back up into the 40s. Right now, we're just into this chop. I think any dip here should probably be bought longer term. Short term, a heavy weighting is just going to be on the progress of where Brexit goes in the negotiations. Now, they're eventually going to get it right. Politicians always do, but they never get it right early. Kind of like Microsoft software. Version 1 through version 5 has got a lot of bugs in it. Eventually, they get it squared away. Same thing with the British pound or politicians. They'll eventually get something negotiated. And when both sides are bitching, then you know it's a fairly good deal because both sides had to give up something to get the deal done. Okay. If we come over here and look at gold, gold is kind of doing what I had indicated it would do, which is pull back. Now, this is a weekly chart, but you can see this trend line where gold has come right back down to the trend line and it tested, right? So you can just see here, the trend line validity was established right here and it was reestablished here. And then on that deep pullback, we corrected right back again. So any pullback to this trend line, it's worth buying gold. All right. Right now, that candlestick tends to look like a hammer, which means it could go higher. Buyers want to come in, but I think there's going to be trapped, and we're going to go into a consolidation mode for a bit. If interest rates start going higher, you're going to see gold come back down a little bit if we get that kind of scenario playing itself out. The other one that I like, is copper. Okay, copper, we got long copper futures right back over here, or Freeport McMoran, which is a proxy for copper. It's an ETF. And this thing is just taken off like crazy. We've doubled our money in it, made even more for our members that went into the copper futures. Just a really good trade, guys. I mean, a really nice one. And then, of course, if we come over here and look at silver, and I've been reviewing this with our members, so you guys are just well on top of this one. When silver broke out right here, my recommendation was to play silver over gold because the return on capital will be much higher. And that's exactly what happened. The silver gold ratio has come down a little bit. It got too out of whack. So if you wanted to be long precious metals, you wanted to be long silver or SLV, not copper. Now we're into this almost like a symmetrical triangle kind of pattern. The upside breakout is the typical forecast of a symmetrical triangle when you approach it from the bottom up. So that's kind of what I would expect, but I think we have more room to go. It's just kind of in a sideways mode until this thing sorts itself out. Let's go take a look at gold. I'm sorry, not gold, oil. Oil has just been in a really tight range. Look at that range right there. I mean, these candles, if I blow it up a little bit just to come in and look, we've just been grinding higher, but each day we're not getting these big moves. It was down today or this past week, but it's been fairly steady. It's a really good trade to put on in the futures market and play it with options because it's not moving too much and it's staying within a range bound area. So flies and condors have worked out well here. And with most brokerage platforms, when oil went below zero, you've got to go out to a back month futures contract to be able to trade it. They're not going to let you trade the front month like they did. That'll probably wear off after a while, but they're still being strict on what you can and can't do in the oil markets, at least in Thinkorswim anyway. So that's what we're sitting there now. Nat gas, look at nat gas. It is just to the moon right here. Now, we were only approaching this from the bullish perspective, but mostly bull put spreads, right? Which are credit spreads. We were doing bull put spreads when nat gas was hovering around the bottom down here, and that we were able to come out well south of this area and just play the credit spread to the upside. I'm not ready just yet to do a credit spread to the downside with bear call spreads, right? Not yet. I want to get a dip and then another run higher. I want to get some divergence in the MACD, and then I'll be looking at bear call spreads. Right now, we're not there yet. Okay. Now there's some other opportunities approaching in the meat market and possibly in the ag market. Members, I'll review these with you in our weekly session tomorrow evening. If you're not a member, I highly encourage you to come in. We're having some great trades. We're doing well in the markets, even given the pandemic. There's some really good trades that we're putting on. You guys can follow along with in our secret trader for you members out there. For non-members, come on in and join us. We're having a good time. Otherwise, enjoy your weekend. And folks, members, I'll see you tomorrow evening in our weekly market watch at 8 p.m. Eastern Standard. Take care, folks. Ciao now.